So whoever has a question can just put the question in the chat room, or you can. So when it comes to tax audit, that is about examining the taxpayer's records, and they want to check whether the taxpayer is complying or the taxpayer is not complying. That is the tax audit. So we can say that tax audit is the examination of the taxpayer's records in order to assess tax compliance. That is what we call a tax audit. You examine the taxpayer's records, and the main objective is to assess whether the taxpayer is complying or is not complying. So, what are the conditions for tax audit? Condition number one, the taxpayer must be informed seven days before the audit is conducted. The taxpayer must be informed 7 days before. That is a comprehensive audit. If it is a special issue audit, then the taxpayer must be informed within 3 days. This is for comprehensive audit. For comprehensive audit. For a special issue audit, so if it is a special issue audit, the taxpayer must be informed within 3 days. For example, if it's a VAT refund, it can be 3 days before the audit is going to be conducted. Condition number two, the documents required during the audit. The taxpayer must be informed or must be told the documents that are needed during the audit. The press where the audit will be conducted or will take place. So another condition is that the taxpayer must be informed the press. This is very common if a taxpayer has got very many branches. You need to inform the taxpayer which of the branch that is going to be audited. The duration of the audit, the duration of the audit, how long will the audit take? That is also very important information to tell the taxpayer. So another thing we can talk about is the types of audits. Well, before we look at the types of audit, we can talk about the unique audit principle. call it new audit. In the normal case of the business, in the normal course of auditing, a taxpayer is supposed to be audited once. So in the new audit, what we are looking at are those circumstances where a taxpayer is going to be audited more than once in a given tax and in a given tax period. That's what's called a new audit, or sometimes called a unique audit principle. So this is when the taxpayer is audited more than once. The taxpayer is audited more than once in a given tax and in a given tax period. That's what we call a unique audit principle, or sometimes we call it a new audit. Let's look at the reasons. Reasons for new audit. Why? Because we are saying in the normal cases, a taxpayer is supposed to be audited once. That's the normal circumstances. A taxpayer is supposed to be audited once. Why then should a taxpayer be audited more than once in a given tax period and in a given tax? The first reason, if there is conspiracy, between the taxpayer and tax auditor to evade the tax. If the taxpayer collude with the tax auditor with the aim of evading tax, in that case, a new audit will be conducted. So the tax auditor and the taxpayer can negotiate with the aim of evading tax. Then a new audit is going to be conducted. Reason number 2. If it is discovered that the first audit was based on a wrong data or a wrong information, then a new audit will be conducted. If they discover that during the first audit some documents were wrong, then a new audit is going to be conducted in that case. Reason number 3. If the first audit was issue related, meaning that in the first audit they were just examining a specific issue. For example, maybe the first audit was only focusing on VAT, was focusing on receivables, was focusing on inventories. You were auditing a specific issue. Then a new audit for comprehensive will be conducted. Reason number 4, the Commissioner General So if the Commissioner General cancels the first audit, probably they have discovered a new information, or the taxpayer has come up with a new information, then they can cancel the first audit, and then a new audit is going to be conducted. So those are the reasons for conducting a new audit, what called the unique auditing principle. Let's look at the types of the tax audit. Types of tax audit. We have what called a contradictory audit. We have a contradictory audit. In a contradictory audit, it is similar to what we used to call rectification note, because a contradictory audit is done if there is some misstatement, mispresentation, omission. That's when a contradictory audit is conducted. So you can see that this is done if there is a mispresentation, omission, or misstatement of information. If in the tax declaration there is a mispresentation, there is omission, or there is some misstatement of information, then a contradictory audit is going to be conducted. That's what we call a contradictory audit. It is similar to what we used to call rectification note. Number 2, desk audit. A desk audit. A desk audit, it is an audit conducted in the office of the tax administrator. So it is an audit which is conducted in the office of the tax administrators. That is what we call a desk audit. You don't go to the field, but it is conducted in the office of the tax administrator. So what are the reasons for desk audit? Reasons for desk audit. Why should a tax administrator conduct a desk audit? The first reason for conducting a desk audit is the income for tax declared for tax is different from the income declared in the VAT returns. Income declared in the VAT returns is, or turnover, that's the best. Turnover declared in the VAT return is different turnover in income tax. So if the sales that were declared in your VAT returns, because every month you make a VAT declaration. So if the sales that were declared in the VAT returns is different from the sales in your income tax, then a desk audit is going to be conducted. Number 2, tax declared is different from the tax paid. So what the taxpayer declared is different from the tax paid. So in such case, a desk audit is going to be conducted. Number 3, so we talked about this in our income tax. There are some expenses which are allowed and some expenses that are not allowed. So if in the computation of the tax base for income tax, the taxpayer considers some expenses that are not allowed, that can trigger a desk audit. Last but not the least, the taxpayer was did not declare some invoices. So if it is discovered that some invoices were not declared by the taxpayer, then they can conduct a desk audit. So those are some of the reasons for conducting a desk audit. Then another, I think I used the wrong numbering here. I should have used A, B, C, then D, so that I can have number 3. We got issue related audit. Issue related audit. In a issue related audit, it involves auditing a specific, focusing on a specific issue. For example, VAT, receivables, inventory, payee. The tax administrator is focusing on a specific component. That is what called an issue related audit. This is where the tax administrator or the audit So that is what we call an issue related audit. you don't do a comprehensive, you only make a focus on the specific audit. Then number 4 is the audit without notes. Audit without notes. So remember we said the condition for audit that a taxpayer has to be informed before the audit is conducted. But there are some circumstances where an audit can be conducted without giving a notice to the taxpayer. For example, if a taxpayer has not made any declaration of tax, then in that case, they can conduct an audit without notice. This is where an audit is started without giving a notice to the an audit is started without giving a clear notice to the taxpayer. So what are the reasons for audit without notice? Reasons for audit without notice. If a taxpayer, the first reason we can look at is that if a taxpayer has not made any tax declaration, then an audit without notice can be conducted. Reason number 2, the taxpayer declared the tax rate. The taxpayer declares the tax rate. If the taxpayer declares the tax rate, we know the deadline for declaration. So if the taxpayer declares the tax rate, so in that case, an audit without notice can be conducted. So another reason is that if a taxpayer make a declaration, but the declarations are not accompanied with the necessary documents. For example, when you make a declare, you must put the statement of profit and loss, statement of financial position, statement of cash flow, list of invoices, list of assets, etc. Those are some of the documents that should accompany your declaration. So if a taxpayer makes a declaration and does not attach these necessary documents, in that case, an audit without notes can be conducted. The taxpayer does not cooperate in giving the necessary information. If there is probably an audit and the taxpayer is not willing to give an information, then an audit, an audit without notes can be conducted. Last but not the least, if there is suspicion of a fraud, if they suspect that the taxpayer is making a fraud, then they can conduct an audit without notes. So these are the 4 different types of audit that can be conducted. The first we said it is a contradictory audit. We have a desk audit. We have an issue-related audit, and then we have an audit without notes. It's not notes. It is this one. Sorry, audit without notes. So another thing I want us to talk about here is what we call a burden of proof. So I'm combining now almost the burden of proof. When we say burden of proof, these are like costs that are incurred when establishing an affidavit. That's what we call a burden of proof. Costs, expenses, as you are establishing an affidavit or you are establishing an evidence, the costs that are incurred in establishing an evidence. So these are costs incurred when establishing an evidence, or we call it affidavit. So the costs incurred during establishing an evidence is what we call a burden of proof. Now, some burden lies to the taxpayer and other burden lies with the tax administrator. So what is the burden for the tax? Burden of proof for the tax administrator. What are the burden of proof which lies with the tax administrator? It's okay. So process to rectify the tax declaration of the taxpayer. So if the tax administrator starts a process to rectify the declaration that were made by the taxpayer, the burden of proof lies with the tax administrator. So assessing the tax based on signs and the indicators of prosperity. What we mean here is that the tax administrators have got the power to assess tax based on sign and indicators of prosperity. So the burden of providing that evidence, economic evidence of prosperity, also lies with the tax administrator. If you want to prove that this person has economically grown, or this person has purchased a motor vehicle and the money came from the business, providing that affidavit that the taxpayer purchased a motor vehicle and the money which was used was from the business, it is also a burden to the tax administrator. So another burden of proof is when you are processing a search warrant from the public prosecutor. If you want to go and search the taxpayer, most especially the private section of the taxpayer, you want to search the home of a taxpayer. In that case, you need to ask to get a search warrant from the public prosecutor. So the cost involved in getting that search warrant, it is borne by the tax administrator. Another one is permission to ask a person bound with professional secrecy. For example, if you want to get information about the taxpayer from the bank, in that case, you need to get a permission from a public prosecutor for the bank to give you information about the client, because a bank is bound with the professional secrecy. Even auditors are bound with the professional secrecy. So if you want to get information from the auditor about the taxpayer, you need to have a permission from the public prosecutor. Even doctors are bound with the professional secrecy. So if you want to get information about the taxpayer from a doctor, you need to have a permission from public prosecutor. So those costs involved in getting that permission, they are bound by the tax administrator. So we can look at the burden of proof. So what are the burden of proof for the taxpayer? Starting an appeal procedure. If a taxpayer discover that he has made a mistake in the declaration and they want to correct the mistakes that were done in declarations, the process of appealing to correct an intentional error in the tax declaration, that those processes are borne by the taxpayer. Number two, disapproving the content of an affidavit. If we want to disapprove the content of an affidavit, so maybe the tax administrator has come up with some affidavit and you want to disapprove that the affidavit they have is not correct. So that procedure is borne, it is a cost for the tax administrator to disapprove. The tax administrator conducted if the tax administrator conducted an assessment without notes, an audit without notes, the burden lies with the taxpayer for conducting an assessment without notes. I also want us to talk about this, the tax recovery procedure. How do we recover tax, or procedures to recover tax? Number one, we have what we call a notice of assessment. A notice of assessment, that is one way to recover tax. A notice of assessment is a legal document which is issued by the tax administrator to the taxpayer for recovery of taxes together with the penalty. It is a legal document issued by the tax administrator A notice of assessment, as we have already said, it is a legal document which the tax administrator issues to the taxpayer in case they want to recover taxes and penalties. Probably the taxpayer made it under declaration, the taxpayer declared tax rate, there's a mispresentation of information in the taxpayer's records, then they can issue a notice of assessment. It is about tax recovery. Another one, we have already talked about it, is a tax audit. Tax audit. It is also a tax recovery procedure. You want to recover tax by examining what the taxpayer is doing. This one we have already talked about it. I'm not going to explain it more. Number 3 is what we call a seizure. A seizure, that is when they attach a property of the taxpayer in order to recover tax. That's what we call a seizure. It is when the properties of the taxpayer are attached in order to recover taxes. That's what we call a seizure. So if it is a seizure, the properties of the taxpayers will be sold within 80 days, or the properties are sold. The properties are sold under a public auction. Within 80 days. That is what we refer to as a seizure. You attach the properties of the taxpayer in order to recover tax. Number next is what we call lien. A lien. A lien, you don't take the properties, but you attach the income from the properties, or the income from the properties are attached in order to recover taxes. For example, if it is a motor vehicle, you attach the income that comes from the motor vehicle. If it is a building, you attach the incomes which comes from the building. That's what we call a lien. This is when the income from a property is attached in order to recover taxes. So that is what we refer to as a lien. Then the number next, or what we call E, is what we call third party. So in a third party, the tax administrator can write to either the receivables or can write to the bank for not giving the money to the taxpayer, and the money is paid direct to the account of the tax administrator. Or if it is a bank, they can freeze the account and you cannot be able to remove the money from the account until the taxes are paid. So this is when the tax administrators write to either the receivables or debtors bank for not releasing so they can write to the either the debtors of the company, or they can write to the bank instructing them not to release money to the taxpayer. That is what we call a third party. So these are procedures that are used in tax recovery. Another thing I want us to talk about before we look at investigation is interest, fines, and penalties. And the first one we are going to talk about is the interest for late payment. So if a taxpayer pays tax rate, you will be charged an interest of 1.5% per month, non-compounding. So you just look at the interest supposed to calculate on the tax, and then you multiply by the number of months the taxpayer has delayed to pay that tax. So if the taxpayer pays the tax rate, will be charged an interest of 1.5% on the tax. Per month, non-compounding. So you just look at the amount of tax the taxpayer was supposed to pay, multiply by 1.5%, then multiply by the number of months the taxpayer has delayed to pay. Then we also have fixed fines. Fixed fines. A fixed fine is charged for failure to declare and pay tax, failure to declare and pay tax on time, failure to withhold, failure to withhold the tax on time, failure to register for tax, and others. So these are fixed fine. If you don't declare tax on time, you don't pay tax on time, you don't withhold the tax, or you don't withhold the tax on time, if you don't register tax on time, for tax on time, you will pay a fixed fine. So the fixed fine is the fixed fine is 100,000 if the turnover is below 20 million, meaning if your turnover is below 20 million, you are going to pay a fixed fine of 100,000. Now, number two, if it is going to be 300,000 if the turnover is above 20 million. 300,000 if the turnover is above 20 million. And for public and non-governmental organizations. For business, which is where the turnover is above 20 million, you are going to pay 300 for failure to declare or pay or what. If it is a non-government organization or public, the starting is 300,000 if you don't declare tax on time or you don't pay tax on time. Number three, it is 500 if the taxpayer is a large taxpayer. If the taxpayer was informed that he is a large taxpayer, then the fixed fine is going to be 500,000 if he's a large taxpayer. So, and then if we go to penalties, the first one we're going to talk about is late declaration and payment. In that case, we are saying that if a taxpayer declares late and also pay the tax late. So if the taxpayer declares and pay the tax rate, will pay the following penalty. So if the taxpayer, it will be 20%, that is one. If a taxpayer pay and declare within 30 days, if the taxpayer declare and pay within 30 days. If a taxpayer declare and pay tax within 30 days, then in that case, the taxpayer is going to pay a penalty of 20%. 20% of the amount of tax, of the amount of tax. Then 2, it is 40% if the taxpayer declare and pay within 31 to 60 days. If a taxpayer pay within 31 to 60 days, then you're going to calculate the penalty at 40%. Then C is going to be 60% if the taxpayer pays, declare and pay, declares and pay in more than 30 days. If the taxpayer declare and pay tax in more than 30 days, more than 60 days, so in that case, a taxpayer will be charged a penalty of 60%. So you look at the days when the taxpayer was supposed to declare, and then you compute the penalty based on the number of days the taxpayer was late to declare and pay tax. Then number 2, declares on time but pays tax late. So a taxpayer has declared on time, but the tax is paid late. So what are the penalties in this case? I'm copying this same. So if a taxpayer declare tax on time but pay the tax late, he will be charged a penalty of 10% if the tax is paid in 30 days. If the tax is paid in 30 days, in that case, he's going to pay a penalty of 10%. The penalty will be 20% if the tax is paid between 31 to 60 days. And the penalty is going to be 30% if the tax is paid in more than 60 days. So this is the late declares on time and then pay tax late. And number 3, under statement, under statement of tax. In this case, you declare an understated tax. Please, these penalties are calculated on the amount of tax. So, number 1, if the amount understated is below 20%, the penalty is 10% of the amount understated. If the amount understated is below 10%, the penalty will be 10% of the amount understated. Then if the amount understated is above 20%, the penalty is 20% of the amount understated. Now, what you do here, for example, I can give a simple example here. A simple example, maybe the taxpayer declared, at 20 million, let's say, and the actual tax maybe was 24 million. So what we do is to get what was understated. Understated is 24M minus 20M. Then you have 4 million was understated. What is the percentage of understatement? Percentage of understatement. It is 4 million divided by 24 million. Four divided by 24. So the amount understated is, the percentage of understatement is 17%, which is below 20%. So the penalty here, penalty of understatement will be amount understated, which is 4 million, times the penalty, which is going to be 10%. So this percentage is to help you to know how much should you charge as the penalty. So that will be the penalty for understating the tax. Now, if a taxpayer realizes voluntarily declare the amount understated on time, the taxpayer will not pay additional penalty. But if the taxpayer is issued with a notice of assessment on under declaration, then they are going to pay an additional penalty. If the taxpayer voluntarily declares the amount understated, no additional penalty. Will be paid. But if the taxpayer is issued with the notice of assessment the following penalty will be charged. So if the taxpayer is issued with a notice of assessment for under-declared tax and they pay the tax within the first 30 days, will pay a penalty of 20%. If it is paid between 31 to 60 days, the penalty is 30%. If it is paid in more than 60 days, then the penalty will be 40%. Then we also have a penalty for failure to provide information. A penalty for failure to provide information. So if a taxpayer fails to provide information, in that case, the taxpayer will pay a penalty of 5% of the transaction value. If the taxpayer fails to provide information on given transaction, the penalty is 5% of the transaction value. If a taxpayer understands the tax paid, does he pay interest? No, the law does not provide the interest. The interest is only on late payment. But if it delays to pay within this period, it will pay an interest also. Because you are supposed to pay it within a given period. If you delay to pay it, then you are going to pay an additional interest. So these are the first part that I wanted us to talk about, which is about audit and assessments and the tax recovery procedures. So another part I want us to talk about is tax investigation. Tax investigation. Now, tax investigation, it is about still assessing the taxpayers' records, but the purpose is a bit different. For the purpose for tax investigation is to verify an accuracy of an information, or to verify if the information about the taxpayer is accurate or is not accurate. So we do an investigation if you have got a certain information about the taxpayer. Then you are investigating to find out if that information is correct or is not correct. That is a tax investigation. So we can say that it is the examination of the taxpayers' records in order to verify an accuracy of information. You examine the records of the taxpayer, but the purpose is to verify whether the information about the taxpayer is correct or the information is not correct about the taxpayer. That is what we call a tax investigation. Now, the other part, most of the parts, you can go through them, but what I want us to discuss more here, which is very examinable, is what we call income reconstruction. Income reconstruction. Sorry. When we say income reconstruction, it is about determining the taxable income and the tax payable of the taxpayer, where a taxpayer does not have full set of accounting records. That's what we call an income reconstruction, determining the taxable income and the tax payable of a taxpayer where there is no complete set of accounting records. This is very common in a small businesses. Small businesses, because they don't have professional accountants, they don't keep full set of accounting records. So if you are to assess their tax, it requires you to make a lot of adjustments in order to be able to determine the taxable income. So we say that it is the process of determining determining the taxable income and tax payable. Where no full set it is the process for determining the taxable income and the tax payable of a taxpayer if a taxpayer does not keep full set of accounting records. So in a we have got different methods of income reconstruction. So we have what's called the direct method. Direct method is used more if the income of the taxpayer are very small, or if the transactions of the taxpayer are very small, and the taxpayer also works with the bank. That's when you can use a direct method. So what you only look at in this method are the transactions deposited in the bank. Any deposit in the bank, it represents an income. So you only check what the taxpayer deposited in the bank, and then you establish an income for that particular taxpayer. So this is used if the transaction of the taxpayer are small and the taxpayer also work with the bank. Involves analyzing the deposits made by the taxpayer in the bank. So that is what we are saying on this method. You only use this method if the taxpayer has got few transactions, and the taxpayer also works with the bank. If it does not work with the bank, it is very hard to find income in this for the taxpayer in this case. So any deposit a taxpayer made in the bank, it indicates an income. Any deposit, it represents an income. I'm not saying that a debit represents an expense. For debit, you need to establish whether it is allowed or not allowed debit. But any deposit, unless the taxpayer disapproves that, it represents an income. And from that, you can be able to establish the incomes and then be able to determine the tax. So number 2 is what called indirect method. And indirect method involves the following. We have also deposits, which we have already talked about up there. We have use and application of funds. We have net worth. We have the backer duty. We have the sales markup. These are the common ones, but our most important ones are these two methods. These ones are the ones that are very examinable. They look similar but a bit different. Use a net worth method and the backer duty method, or what we call capital backer duty method. So deposit, which is the one we have looked about it, you are assessing the deposits in the bank. If you look at the first one, deposits, so it involves assessing or examining the deposits made by the taxpayer in the bank. That is what you only do for that. You only analyze the deposit a taxpayer has made in the bank. Any deposit, as I've already said, any deposit in the bank, it represents an income. Any deposit in the bank, it represents an income. Any deposit you see on the banker statement, it represents an income. Unless the taxpayer has got explanation that it is not income. But if there is no explanation, then any deposit is going to represent an income. Then number 2 is the use and application. Use and application of funds. Using and application of funds, what you do is to compare the cash receipts and the cash payments. If the cash payments are more than the cash receipts, the difference represents an recorded income. So this involves comparing the cash receipts and the cash payments. If the cash receipts, so the cash payments are more than the cash receipts, the difference represents so that is the use and application of fund. You only compare your cash receipts and the cash payment. Any difference, if the cash payments are more than your cash receipts, it means there are some income that were not recorded, because you cannot sell 1 million and you pay 2 million. It is impossible. So anything that is different, it represents an income that wasn't recorded. That is the use and the application of funds. Then number 3 is what we call the net worth method. And we say this involves comparing the equity at the beginning and the equity at the end. So in this method, what you do is to compare your equity and your equity at the beginning and the equity at the end. So if at the beginning you had an equity, your total equity was 2 million, and at the end you have a total equity of 20 million, then it means the difference represents the income generated for the year. So we can look at a simple example. A simple example here. How many classes are called later? How many classes? let's go through this simple question and see how to use the net worth method. Mukamana owns a grocery shop. She has not been keeping full set of accounting records. On 10th May 2022, received a notice of assessment, of course, from RRF 15 million for unpaid taxes for the year ended 31st December 2021, together with the interest and other penalties related to unpaid taxes. Although she does not keep full set of accounting records, the following information is available. We have these items on 1st January, and we have the items on 31st December. Then we have been also given that after perusing, not pursuing, it should be perusing. After perusing through the available records, you also discovered the following. She takes 10 kilograms of rice at home every week, 2 kilograms of sugar, 5 kilograms of maize flour, and 2 liters of oil every week. And those are the prices. She has an insurance policy with her family of 500 per month. It is a standing order in the bank. Advise her on whether to appeal for overassessment by RRA. So we can look at this question. As we said, what you need here is to get the equity at the beginning and the equity at the end. So what was our equity at the beginning? Equity at the beginning. So I can first get here my total asset here. These are the assets. So my total asset, then these are the total assets. Then I have my equity and liabilities here. Equity and liabilities. Equity. Then I have the liabilities. So what is my equity? These are the equity component, the liability component. So my, of course, total equity and liability, total equity and liabilities will be 54. So the difference here will give me my equity. So I will get this minus this minus this. So this is the equity the company had at the beginning, including capital and so what is the equity at the end? Equity at the end, that is 31st December 2021. So I'm going to still make the same. I'm going to copy this item at the end. So total asset here will be my total assets will be that. So what is my equity and liability? Then liabilities. Liabilities, I have them. They are here. It's a bank loan and These are the liabilities. So my total equity and liability will be total equity and liabilities will be this 94. So my equity will be this minus this one. It is 76. This is the component of equity. So it means the income for the year will be the equity at the beginning, equity at the end, minus equity at the end, at the beginning. So our income for the year, I'm going to have equity at the end, which is, this is the total equity, 76, less equity at the beginning or on 1st January 2021. This is 31st December 21. This was the equity. So it means profit for the year will be profit for the year is going to be this minus this. That is the profit for the year. So on profit for the year, then I'm going to consider this other information that I have here, like personal consumption. I can make a simple note here for personal consumption. Working number 1, it is personal consumption. So my personal consumption, we shall have the rice. It is going to be, because they are taking 10 kilograms every week, times 52, times the price of rice, which is 2,000. Then another one is maize flour. Maize flour, it is 5 kilograms every week, times 52 weeks, times the price for maize flour, which is 1,000. Then another one is sugar. Sugar, they take 2 kilograms every week. It's 2 kilograms times 52 weeks times the price of sugar, which is 1.5. Another one is 2 liters of oil. Oil takes 2 liters, which is 2 liters times 52 times 35. So our total personal consumption is that 182. So I add back the personal consumption. Add back personal consumption. Which is 1 million 820. Then I still add the personal insurance. Add personal insurance. The personal insurance is saving how much per month? 500,000. So it is not allowed. This is a personal expenditure. 500,000 times 12. That is the personal insurance. Then this is the adjusted profit. Adjusted profit. Then I less depreciation. Less depreciation. This is going to be my working number 2. I think I can put it somewhere here also. Working 2 is depreciation. So the asset we have, I can write them here. We have, these are the only assets we have. Those are the assets on 1st January 2021. Then we have a new asset. So if I check my items here, if at the beginning I had furniture of 2015 and at the end I have 20, it means I purchased furniture of 5. So I have furniture of 5 purchased. Computers, at the beginning I had the computers of 2 million and at the end I have computers of 6. It means I purchased computers of 4 million. These are the computers purchased. So what is the depreciable base? Our depreciation base will be here. So then our depreciation rate this is 25%, this is 50%. Now you can compute your depreciation. Or wear and tear. This is this times this. So the total depreciation is 80 million. So then I'm going to recognize down here. So my taxable profit is 49. Now I can compute. This is an individual person. Is Mukamana, is an individual. So I can now charge my personal income tax, my PIT, to be from 0. I don't know. We're still using the old. It has changed, but please don't use the new in your calculation. Use the old law. I know here it has changed, but don't use the new law in your calculation. Please still use the old law because the examination was set on the old law. Don't use the new law. So this is going to be 360. So this is a 0%. I can invest 0%. The other one is 0. Then from 360 to 1.2, we're going to charge 20%. So it's going to be 168. Then 1.2 to 49, 820. You're going to charge 30%. Isaac, I don't know, but that's what my advice. Please use the old law. So we are having this minus times 30%. So then the total here will be 14 million. This is the tax payable. Then you can charge the penalty for failure to declare tax, fixed fine for failure to declare. We have a fixed fine for failure to declare. Which is 300,000. Then you have late payment and declaration. Late payment and declaration, which is going to be since how many days. That's where we needed to look at. The notice of assessment was issued when on 10th. He was supposed to declare on 31st March 2021, and the notice of assessment was issued on 10th May 2021, meaning is between April is between 30 to 61 days. The days delayed. Days delayed is between 31 to 60 days if you calculate those days. So it means the penalty will be 40% here. It will be 40%. So we get the principal tax, which is this, times 40% penalty. Then we also have interest on late payment. There are 2 months, it will be 1.5% times 2 times the tax. So we are getting our principal tax times 1.5% times the 2 months delayed. That's the interest. So the total tax plus penalty. Total tax plus penalty is this. So notice of assessment issued is 15. So the question is, we are advised whether should appeal for overassessment. Based on the notice of assessment, she should not appeal for overassessment. She should not appeal for over-assessment. She shouldn't appeal for over-assessment. That is the advice that we can talk about in this case. I don't know if you have a question on this part. Any question regarding this part? Another method is what called capital backup duty, or sometimes called backup duty. Capital backup duty. I think that is method number for your net worth. It is D. How is the decision taken? What is the rationale for of the advice? Because this is the notes of assessment. Because the question was, should she appeal? That was the question we were answering. Should this person appeal for over-assessment? So based on what we are calculating, if she appeals, she will pay this. If she pays what was assessed, there will be no problem for her. So she shouldn't appeal for over-assessment, because if she appeals, she will pay more. So that is the capital backup duty. The other one was not now the capital backup duty. What you do is to also, it's almost works the same way as in a net worth method, because what you want is to find the net asset value, and once you have the net asset value, which is the net worth, then the increase in the net asset value, it gives you an income. And you can, this works similar to net worth method. It involves determining the net asset value. An increase in the net asset value represents an income or profit, while a decrease represents a loss. So you do almost the same. You check your net asset value. Any increase in the net asset value, it represents an income, and any decrease in the net asset value, it represents a loss. So to get the net asset value is equal to total assets less liabilities. You get the total assets minus the liabilities, then you do the net asset value. It's almost similar to this. So we can look at an example on this. They copied very many questions but you delayed to enter, you may not be able to do all the questions. How come? Probably you can do the question here. I'm trying to copy it. It is bringing different things. Let's do it here. I think it's the same. You can always look at it. When I copy it, it brings different issues that I don't understand. This is a question of March 2022, question number 4. Miss Igabe Grace has been operating a supermarket at Kagugu, Gasabo district in Kigali for the last 3 years. She has only made a tax declaration for 2018. In 2019, she laid off the accountant, and thus she has not been keeping the books of accounts and has not made any tax declaration on her business income since then, meaning no declaration in 2019 for 2019 and no declaration for 2020. On 1st April 2021, she received a notice of assessment from Rwanda Revenue Authority indicating that she is supposed to pay a personal income tax of 87 million from the unpaid taxes together with the interest and penalties since 2019 when she stops declaring. Ms. Igabe does not agree with the assessment of RRA. Unfortunately, she doesn't have full evidence to support her appeal. Although she does not have full information about her revenues and expenses, she has full information relating to her assets and liabilities and some other information that she thinks will help during the appeal process. Ms. Igabe Grace has approached you and she needs your assistance in processing the appeal and supplied you with the following information. So these are the financial reports for the company, and these are the additional information. And we are supposed to advise whether to appeal for overassessment. It's like a similar to what we saw in our previous part. I don't know if you can get me these totals very fast. Our total assets. Oh, I needed to write, I think. Our non-current assets. I have motor vehicle. I have furniture. I have computers. I have a bond. Current assets. I have inventory. I have receivables. I have cash. is 25. Hmm. 25. This is 2018. You know it's 2019 because I'll put in commas. 2020. 25. 60. Furniture. It is 10. 12. 25. Computers. 400. 4800. 55. A government bond. 40. 69. 70. So I can my current assets, inventory 15,400, 30,800, 30,500. Receivables 2,100, 11,800, 30. Is it November? No, it is no, I think I wrote it there. 2022 March. Huh? No, it's November, sorry. I think I made a mistake. 2022 November, sorry. December, sorry. November. I think I don't know how I wrote. It's November 2021. Yes. Oh, I think I wrote it. I wrote wrongly. 10,900. 8,700. 12,600. Then you can get our total asset here. These are the total assets. Then liabilities, I have, if I check the liabilities, I have a bank loan and I have account payable. So the bank loan is 30. Then I have 25,800. Then I have 15. 19,500. 10,600. Then I have 16. So total liabilities will be, these are total liabilities. So I have my total asset here and I have the total liabilities here. Then I can get my net asset value, which we said it is the assets minus the liabilities. Assets minus liabilities, I get the net asset value. So then I said to get an income, the income for the year. So 2018 is my base year. So I only look at this one minus this. I get the income here. Why is it a minus? See this minus this. Then here it will be this minus this. Those are the incomes for the year. So if I don't have any adjustment, I just calculate my tax here. But the question has given us some adjustment. They told us she has not been depreciating her assets since purchase, and thus they are recognized at cost. So we need to recognize the government bond has a maturity of 10 years and the interest is 12% per annum. This was not recorded. So we need to add unrecorded income. Add unrecorded incomes. For 20 here, because it's 12%, we are going to get 12% times the value of the government bond, which is this. 12% times this. And here, still 12% times the value of the government bond, which is this. So that is the bond. Then they told us the interest on the bank loan is 15% on the available balance. She has a standing order for health insurance of family of 2,000. This, so we add back unallowable expenses. Non-allowable, add non-allowable expense. We have a personal insurance. Personal insurance, which is 200 times, because it's 200 times 12. Oh, we remove 3 zeros, eh? So we add here, we shall get how much? So then they told us we have not depreciated and we have a banker interest. So we less allowable expenses, less allowable expenses. First we have a banker interest. Banker interest, which is at 15%. So remember, loan you calculate on the available balance. So if the loan, if our loan is on this balance here, will be the balance here. So to mean this, we shall calculate 15% times 30 here. That will be the interest. So we also look at depreciation or capital allowances, which is working in number 1, I think. we can put it here. Our assets, I think we only have three assets we need to depreciate. And these are the costs in 2018. So 2018 cost at 2018. Remember, this asset will depreciate on reducing balance. So our depreciation rate this is 25%. This one is also 25%. This one is 50%. So depreciation so this will be the depreciation in 2018, but we don't need the depreciation in 2018. What we need is the depreciation in 2019. So if we come to 2019, we are going to recognize the written down value. So the written down value here will be this minus this. Then we can check 2019, do we have any new asset purchased? If you compare here motor vehicle, 2018 it was 25, here it is 25, no new motor vehicle purchased. If you come to furniture, we had 10, now we have 12. It means we purchased furniture of 2,000. 2,000 here, new asset. If you come to computers, they were 4,200, 4,800. We purchased another computer at 600. So our depreciable base, our dep base is this. So depreciation is the same. It is this times our rate is not changing. So that is the depreciation for 2019. When you come to 2020, we recognize the written down value of the asset. So it's going to be this minus our depreciation. So new asset, we can check again. For you are comparing now here, we had 25, now we have 60. It means we purchased 35. 35. If you come to if you come here, furniture, we had 12, now 25. So we purchased 13. If you come to computers, we had 48, now 55. So we purchased 700. So our base is now going to be This is our base. Now depreciation. It's the same rates. This one times so those are the depreciation for the 2 years. So here I can bring it here for 2018, 2019 I take this, and 20 I take this. So our taxable income will be taxable income will be that. That's the taxable income. Now we can charge our tax. It is an individual, so you are computing personal income tax. So from 0 to 360, it is 0%. So here it will be 0, and here it will be 0. Then from 360 to 1.2, it is 20%. So here it is 168, and here it will be 168. Then from 1.2 to 65, 368, 65, 508. We are going to charge 30%. So here it's going to be minus 1.2 times 30%. And here it is this minus 1.2 times 30%. So this is the tax payable or tax liability. Now we need to look at the penalties. First we have the fixed penalties. So we have a fixed fine of 300 and 300 here. We have late payment and declaration, late payment and declaration. So we need to look at this first 2019. Remember, they did not declare until the notice of assessment on 1st April 2021. So if you are analyzing 2019, how many days was 2019 late? Such that you can know the penalty. Late declaration and payment. Late declaration and payment 2019. 2019 was supposed to declare 31st March 2020. That was the date to declare. The notice of assessment is on 1st April 2021. Meaning from this date to here has not yet declared the taxes. So you are calculating from 1st April to 31st March 2021, that is 1 year. So those are going to be 13 months. Automatically is exceeding 60 days. So in that case, we are going to apply 60%. So it will be 60%. So we are getting this, our tax times 60%. Then we also here for 2019, for 2020 declaration was supposed to be 31st March 2021, and our notice of assessment is on April 2021. It means that is you are only counting 30 days. So this could be 30 or 30%, 20%. So here we are going to apply 20% here times 20%. Interest for late payment. Here we are calculating for 1.5 times 13 months times tax. Or the other one you can replace, or 1 month. It can be 1 month for the other year. So here we are going to have this times 1.5% times the 13 months that was late. Here it is only 1 month. We are getting this times 1.5% times 1 month. So we have that. So total tax and penalties. Total tax and the penalties will be that, which is the same as this plus this. And our notice of assessment is 87, I think, something. 87,671. 87,671. So in that case, Miss Grace should appeal for over-assessment basing on the available information. I don't know if you have a question. I see it is raining a bit. Any question? I think I can open the microphone. The microphones are open. Any question? Hello? Hello?
Yes,
Do you hear
hello.
me?
Yes,
Yes,
we are hearing you.
Any question on this part?
So far, on my side, I don't have any question.
Other members?
Understandable.
Okay. So that is how we use the backward duty method. What you need is to get the net asset value. Once you have the net asset value, any increase in the net asset value represents an income. So you recognize and then adjust for any other information that you have. So I think that is what we can discuss in this area. I don't know, are we continuing with online after, or we are going to go for physical class at 1?
Continue online.
What other members? Are they
Online.
Online.
So we continue online.
Yes, online is better.
Okay.
And even it is quick.
Okay. So I don't know. That is the end of the first part of our discussion, which is a tax audit and the tax investigation.
So we are coming back at
I don't
1.
know, our members such that we don't leave them so much. I wanted to start tax planning. I don't know, should we start tax planning now, and then, because we're almost 30 minutes to the end of the session. But you may find that the members are waiting for us at the school. What can we say about that?
But I think most of us are here.
Okay. Can you put the comment on our if they are not there, then we can rest for some minutes, and then we can come back again if they have finished their class.
When are you coming back, sir?
I don't know, when are they finishing?
I think they finish at 1 o'clock.
So we come back at 1.
1:30 is better.
We come back at
1:30.
1:30.
Yeah.
1:30 is too far. I thought you were saying half past midday. You are saying half. We rest for 2 hours. That is too far. Because the normal class starts at 1.
At 1.
Okay, Okay, there's no problem.
Let us back at 1.
At 1, eh?
So meanwhile, we share the Excel plan.
Yes? Okay. I think I'll share the Excel after after today's class.
No problem, sir.
Okay, okay.
Yeah, no problem.
Okay, so then you put the members that the class is going to be online such that they can get to know.
They're going to communicate.
Okay.